Good morning and welcome to the press conference after the Monetary Policy Committee. The Monetary Policy Committee of the Central Bank of Kenya met yesterday, December the 5th, 2023. And as is common practice, today we have a press briefing where the Governor of the Central Bank will give some information with regard to the decision that the MPC made and also be able to take your questions. Again, as is practice, we encourage you to please send your questions through Slido. That's www.slido.com. The hashtag for this month is hashtag MPC1223. And as you're sending your questions, please give us your name and the institution you represent. That way we're able to place your questions as we should. And without further ado, I'd like to welcome the Governor of the Central Bank of Kenya, Dr. Kamau Thuge.
Thank you very much, Wallace, and good morning, everyone. During its meeting on December 5th, 2023, the Monetary Policy Committee raised the central bank rate, the CBR, from 10.5% to 12.5%. The Monetary Policy Committee noted that, one, the exchange rate depreciation continues to exert upward pressure on domestic prices, thereby increasing the cost of living and reducing people's purchasing power. Of the overall inflation of 6.8% recorded in November 2023, the exchange rate depreciation contributed about 3 percentage points. Second, the public sector external debt service has risen, thereby offsetting some of the gains made towards the government's strong fiscal consolidation. In addition, the continued weakening of the exchange rate is contributing to a significant increase in the Kenya shilling value of foreign currency denominated debt. And third, the MPC therefore concluded that there is need to adjust the monetary policy stance to address the pressures on the exchange rate as well as mitigate second-round effects, including from global prices. This will ensure that inflationary expectations remain anchored while setting inflation on a firm downward path towards the 5% midpoint of the target range. The MPC will closely monitor the impacts of the policy measures as well as the developments in the global and domestic economy and stands ready to further tighten monetary policy as necessary to ensure that price and exchange rate stability are achieved in line with the MPC's mandate as well as the CBK's mandate. The committee will meet again in February 2024. Starting with global developments and in particular the inflation rate, the headline inflation rates in advanced economies have continued to ease but remain above their respective inflationary targets. Inflation rates in the US, UK, and Eurozone declined in October 2023, mainly reflecting the tightening of monetary policy as well as lower energy prices. In India, inflation declined in October 2023, mainly reflecting lower food inflation. In China, the inflation went into deflation. There was actually a decline in inflation in October 2023, and this largely reflected a weaker domestic demand. On core inflation, that continues to be well above the respective inflationary targets, mainly about 2% for the US, Eurozone, and the UK. But there is a bit of an easing, but nonetheless, they are quite far from their respective targets. On global commodity prices, we see that these remain below the peak levels witnessed in 2022, but oil prices remain volatile, reflecting increased global uncertainties. The price of oil remains below the peak levels that was witnessed in 2022, again due to reduced global demand, particularly from China. Oil prices trended between July and September, as can be seen in the chart. And this was following supply cuts by OPEC, basically to shore up the oil prices. The price of oil has been volatile since October 2023, reflecting increased uncertainties regarding potential supply disruptions from the escalation of the Israeli-Palestine conflict and announcement of voluntary further output cuts by OPEC, again, to shore up oil prices. With regard to food inflation has continued to decline compared to last year. And this reflects ample wheat, particularly wheat and maize harvests in the U.S., and lower palm oil prices, which have been attributed to output in South Asia, as well as reduced global demand. As an exception, global sugar prices remained elevated in October 2023, and despite moderating slightly, they reflected the improved supply in Brazil. But nonetheless, from on a year-to-year basis, we see that sugar prices have increased by 46.6%. Turning on to the global economic outlook, we expect a deceleration in growth from 3% this year, which itself was a deceleration from 3.5% last year. And the projections for 2024 in the World Economic Outlook also show a somewhat slight deceleration to 2.9%. This deceleration is coming primarily from the advanced economies, where we see that the growth last year was 2.6, and this year is expected to be 1.5, and to remain around that level at 1.4 for next year. The main drivers of this deceleration include the United Kingdom, which is expected to experience a slowdown from 4.1 last year to only 0.5% growth, and to remain broadly unchanged at 0.6% in 2024. Similarly, the euro area sees a deceleration from 3.3 to 0.7 this year, but a slight recovery to 1.2% in in 2024. Emerging markets continue to perform relatively well, except for China. India seems to be doing quite well, although there's a deceleration from 7.2 to 6.3, but it retains that growth rate in the coming year, or 2024. For sub-Saharan Africa, there is also a deceleration from 4% to 3.3, but then a recovery back to 4% growth in 2024. And that, in a sense, reflects the developments in South Africa, where there's only a growth of 0.9% this year, and followed by somewhat recovery next year of 1.8. And that's what's driving the slowdown in sub-Saharan growth and their subsequent recovery next year. Turning to inflation, overall inflation has remained sticky in the upper bound of the government's target range since July 2023. In November 2023, we saw the inflation decelerate from 6.9 to 6.8. When we look at food prices, we see food prices inflation reduced from 7.8 to 7.6, whereas the non-fuel also declined slightly from 3.6 to 3.3. But the opposite was the case with regard to fuel, which increased from 14.8% to 15.5%. In terms of the contribution to overall inflation in regards to food, fuel, and non-food and non-fuel, we see that between October and November, the contribution to from non-food, non-fuel remains broadly unchanged at 1 percentage point. The fuel remains also unchanged from 2.9 to 2.9, but food inflation, its contribution to overall inflation has declined slightly from 3 percentage points to 2.9 percentage points. Just looking again at the non-food, non-fuel, just to look at the recent developments, we can see that around February of this year, it reached a peak of 4.4 and has since that time, reflecting the tightening of monetary policy, has declined to the 3.3 just described for November 2023. In terms of the fuel inflation, the main drivers include the pump prices, electricity, LPG, and transportation costs, and other items. Looking at the November 2023, when inflation, fuel inflation reached 15.5, you can see that the main contributors to that inflation were the transport cost, which accounted for about 5.4 percentage points of the 15.5. The pump prices also contributed 3.7, and electricity also contributed 4.1 percentage points. Regarding food inflation, again, we see a reduction in inflation from 7.8 to 7.6. And looking at what is driving inflation, we see that non-vegetables have actually been declining consistently since October 2022, and in November 2023 accounted for 4 percentage points of the total of 7.6% inflation, and vegetables contributed to 3.6 percentage points. The main drivers of vegetable inflation included mainly were onions and tomatoes. Onions prices through November increased by 53.8%. And this was on account of higher import prices from Tanzania and reduced production at home. The prices of tomatoes affected by the flooding and the rains increased by 40.8% year on year through November. And the agricultural survey that was done in November 2023 shows that prices of onions and tomatoes were expected to remain elevated in the coming months due to spoilage and the high rainfalls, transport, as well as the import costs. With regard to the non-vegetable inflation, we can see that there's been a deceleration of inflation from September 2023, when it reached 3.4, and we're looking at commodities such as wheat, maize, milk, and edible oils. And since September 2022, there has been a deceleration from 3.4, as I said, to September, where it reached negative 0.1 and has remained at negative 0.1 for the 3 months from September to November. Again, just coming to sugar inflation, which has been high, and I referred to it when I looked at the international scene. The sugar prices have increased by 39% year on year through November, and contribute to 0.6 percentage points to the overall inflation rate. Domestically, implementation of the government measures to improve the supply of sugar through imports should moderate sugar prices. Domestic sugar factories started to reopen in October 2023 after shutdown for maintenance and are expected to fully reopen in December 2023. Finally, globally, sugar prices are stabilizing with improved sugar from harvests in Brazil and the sluggish global demand, particularly from China, the world's largest importer of sugar. Finally, in this area, and in terms of expectations, market expectations about consumer prices, we do see that in the survey that we undertook on November 2023, that those respondents who expect consumer prices to increase in the next 1 month has increased from 46.3% to 57.2%, whereas those who expect consumer prices to increase in the next 3 months also has increased from 57.4% to 60%, indicating that there continues to be persistent inflationary expectations in the market. Turning to the domestic economy, the economy is expected to continue to strengthen in 2023, and we also expect it to remain strong and robust in 2024, supported mainly by the resilient services sector, the rebound in agriculture, and government measures in priority sectors. In terms of overall growth, we do expect real GDP to increase from 4.8% in 2022, and this year we expect it to reach 5.5% and to remain above 5.5% in the year 2024. And as I said, the recovery in 2023 reflects the recovery in agriculture, which is expected to increase by 5.9% compared to negative 1.6% in 2022. Of course, as I did indicate, the services sector continues to perform quite well and is quite resilient. Last year it grew by 7%. We expect a somewhat of a slowdown this year to 6.4%, and to maintain that level of growth in the coming year. The area that continues to be of concern is the industrial sector, particularly in manufacturing, and we do see a slowdown from the 2.7 recorded in 2022 to about 1.9. Although with the government implementation of some of the programs and projects in the budget, we do expect a somewhat recovery in 2024, so that it experiences a growth of 2.9%. In looking at our leading economic indicators, the ones that are shown in blue, we expect the third quarter GDP growth to be about 5.6%. This composite index of economic activity has in the past predicted relatively well what the likely outcome is likely to be, perhaps with the exception of the fourth quarter of 2020, but of course that was a time when there was a COVID-19, where it had projected an increase of 2.3, but it had expected a contraction of minus 1.4, but the actual outcome was 2.3. I think that is the only big miss that this index has experienced. So we do expect that the outcome for the third quarter is going to be relatively close to the 5.6%. And that strengthens our case for having a growth for the whole year of 5.5%. So just looking at individual agricultural products, we see horticultural exports have have recorded positive growth throughout the year. In October, it was 21.1, but we did see a fairly strong recovery in August, where horticultural exports increased by 94.8% for that month compared to the month of August of 2022. Similarly, tea production has recorded positive growth since April, and for the data that we have for July and August, we do see continued fairly strong tea production. Milk intake turned positive in May and has continued on that basis. There was a slowdown in September, but nonetheless the growth remains positive. And looking at again at individual agricultural crops, we see maize, and this, by the way, these projections are updated through August, and they're from the Ministry of Agriculture. And for maize, is expected maize production is expected to increase by almost 30% from 34.3 million bags in last year, and compared to this year, where we expect production to reach 44.6. Wheat is also expected to increase by 62.6% from 3 million bags last year to 4.9 million bags. Rice continues to have problems because of the flooding. Beans, a huge increase from 5.7 to 11.7 million bags. And Irish potatoes, an increase of 26%. And sorghum, an even larger increase, although it's somewhat of a recovery from the 2020. We expect the sorghum to increase from 1.3 million bags to 3.3, which is an increase of 150.7%. Millet is also expected to increase by 61.8%. In terms of credit to the private sector, it remained stable in October 28, and partly reflecting borrowing for working capital requirements. As you can see, since August, it's been relatively stable at around slightly over 12% year on year. And just looking at the individual sectors, manufacturing, we do see a somewhat a slowdown in credit to the manufacturing sector between September and October, but nonetheless, the 18.4 is it's quite robust. We've seen trade hard slow down from May 2023 to about September, but again we see a bit of a recovery, and credit to the private sector in the trade sector is almost 10%. Transport communication has slowed down, and similarly for consumer durables, we do see a somewhat stable growth of credit to that particular sector. I know this is a bit difficult for you to see, so I'll just maybe just give the broad picture on the balance of payments. We do expect the current account to narrow between 2022 and 2023 from $5.8 billion to roughly $4.3 billion in 2023, and a slight increase in the deficit to $4.7 billion in 2024. In terms of total exports of goods, we expect that to remain broadly unchanged. Last year we exported $7.4 billion, and this year we expect to export about the same amount. In terms of total imports of goods, last year we imported $19.1 billion. There's been a significant reduction in imports, and I'll come back to that later. And this year we expect imports to reach only 17 billion. But we also expect a recovery in next year of 2024 to back to 19 billion. So looking at how we're going to finance the current account, we do see an increase in the capital account and financial account, where in last year we had inflows of about $4.4 billion. We expect this year to be 4.7 and a slowdown in 2024. But the bottom line is that the overall balance of payments, we expect it to be positive. And for our international reserves to increase by 561 million. That assumes some inflow of our disbursements from our development partners between now and the end of this year. But even if those disbursements don't take place, we still do expect to see an overall balance of payments surplus. So again, just looking at the current account deficit, we project it to narrow to 4.1% from 5.1 last year, and we expect it to retain about that level at 4.2 in 2024. So looking at the components of the current account, and in particular the exports, as I said earlier, we do expect export to remain about the same level. From January to October this year compared to January to October of last year, we did experience a contraction or a reduction in the amount of exports from 6.2 billion to about 6.1 billion. In terms of the details of those exports, we see that there's only a few increases in exports. Food and live animals, we see an increase of 2%. We also see an increase in mineral fuels, 10.4%, and more significantly, the medical and pharmaceutical exports, which are expected to increase by actually already increased by 20.3% for the first 10 months of this year. And the iron and steel, which have increased by 4.4%, and lime and cement, which have increased quite significantly by 60.3%. And just looking at the very bottom row, you can see that the total exports for January to October increased by 2.1%. But if you take the 12 months, in other words, from October of last year to October this year, there was a similar reduction of 2%. Moving on to the imports of goods. By January to October, we had imported 13.7 billion, and compared to last year, the same time, where we had imported goods amounting to $16.2 billion. And this is a reduction by almost 15%. The amount of imports for this year through October is 15% less than we had imported during the same time last year. And looking at the individual components of imports, the only category that experienced an increase was food and live animals, where we had an increase of 22%, driven primarily by the increase in cereals imports, where the government had offered some incentives in order to try to address the cost of living by zero rating some of the imported items. So we had a significant increase in cereals imports. But most of the other components of imports, whether it was minerals, fuels, lubricants, declined by 25%. Chemicals have also declined by 12.7%, and manufactured goods have declined by 26%, and machinery and transport equipment also have declined. And just looking at the broader categories of imports, we see consumer imports, a very small decline of 2%, and this is from up to, we have data up to September. Capital imports declined by 27%. Again, this is partly due to some of the completion of the government-funded capital projects and the reduction in the importation of machinery and equipment. We've also seen a significant reduction in intermediate imports of 15%. In terms of the services sector of the balance of payments and looking at the travel receipts, these have been quite resilient, reflecting the recovery in international travel. And as you can see, we did have in the first half of the year, through May, you can see that the arrivals, or rather the receipts, we have a significant increase in receipts compared to the previous year. And then from June to October, the receipts continued to be robust, but slightly less than the previous year. With regard to tourist arrivals, these increased by 34% in the 12 months to October 2023, and these were supported by a recovery in international travel. Diaspora remittances continue to be quite strong. In the first 10 months of the year, they increased by 4.1%, and for the year as a whole, we expect that that 4% increase will be sustained. This is a financial account which I have already described. Coming to the exchange rate, we've seen the exchange rate has depreciated quite noticeably, and as of November, it's about 153.2. And the exchange rate movements, these have affected inflation through the tradable items of the CPI basket, which accounts for 42.8% of the CPI basket. In November 2023, the exchange rate depreciation contributed 3 percentage points to the overall inflation. The continued weakening of the exchange rate is contributing to a significant increase in the Kenya shilling value of the foreign currency denominated debt, as I mentioned earlier. I think this is just to give a comparison of just comparing some of the outcomes within the EAC, East African Community countries, just basically trying to compare Uganda, Tanzania, and Kenya, and where we are on some of the key economic indicators. And this is the current account. You can see the Kenya's current account narrows to 5.1%. This is 2022, and I did indicate this year we expect it to narrow to 4.1. The picture here may be misleading because it shows as if the Kenya's current account is narrower than that of Uganda, which is 7.9, and that of Tanzania, which is 7. The problem with this is that part of the reason why the current account for Uganda and Tanzania are higher than ours is because they have a lot of foreign direct investments. And so this widening of the current account deficit for them is actually being financed to a large extent by foreign direct investments. In our case, and I'll come to that, the current account deficit is not being financed by foreign direct investments, but actually by external financing and loan disbursements. This chart looks at the exports of goods as a ratio of GDP and compares the Tanzania, Uganda, and Kenya. But I think the thing to note is the Kenya's exports to GDP ratio, where it has consistently declined since 2011 from 12.5 to the current level of 6.5. Similarly, on the travel receipts as a percent of GDP, again, if you just look at the last year of 2022, you can see our ratio, our travel receipts to GDP ratio is much lower than that of Uganda and of Tanzania. In fact, in the case of Uganda, it's actually twice as large as ours, from 0.8 compared to Uganda's 1.6. And of course, Tanzania is much higher at 2.8 compared to ours of 0.8. The one area where we are doing much better than our neighbors is on remittances. These have continued to increase. This is a very steady and reliable source of foreign exchange for us. This is external debt service. Again, you can see the burden of external debt service for us is much higher than for our neighboring countries. Again, just looking at even this year, you can see that Kenya's external debt service payments are quite high at 3%, followed by Uganda at 2.3% and Tanzania at 1.6% of GDP. And this is what I referred to earlier, the foreign direct investments. And you can see we reached a peak in about 2011. You can see the peak in 2011 where we attracted foreign direct investments equivalent to 4.8% of GDP. And since that time, every year there's been a decline in foreign direct investments to GDP, up to the point where in 2022, the ratio had declined to 0.7 compared to Tanzania, which had twice as much in FDI at 1.4, and Uganda, which even had much more at 3.2% of GDP. But the point, and perhaps we'll come back to for further discussion on this, the point that we wanted to make there was that we have been losing competitiveness. Our level of exports to GDP ratio has been declining consistently. We are not getting as much tourism receipts as our neighboring countries have. The foreign direct investments have also been declining. And at the same time, our debt service has also been increasing and is much higher than our neighboring countries. And the combination of all these factors have actually led to the weakening of the shilling, and I will come back to that later. The chart here shows the CBK's usable foreign exchange reserves. In 2019, you can see we had a peak of $8.8 million, and this has declined, rose again in 2021, but since that time it is now at 6.7. which is equivalent to 3.6 months of import cover. I hasten to add that despite this reduction in reserves, it is still sufficient, particularly even with a flexible exchange rate, is still sufficient to be able to address any kind of external shocks. On the fiscal framework, I think here is just to, maybe I just jump to the deficit. The government continues to be committed to the fiscal consolidation. We see a deficit of 5.5 in the fiscal year 23-24. This may be a bit of a surprise because what was submitted to Parliament in June had a deficit of 4.4% of GDP. So the initial plan was to lower the deficit from 5.6 to 4.4, and then ultimately to the 3% that is shown there by the year 2027, 2028. However, because of the higher interest rates and because of the depreciation of the exchange rate, the cost of interest payments in the budget has increased quite substantially by about 1 percentage point of GDP, and that's why the deficit has increased to 5.5 in the fiscal year 23-24. Nonetheless, I believe that Treasury later on will be looking at a supplementary budget too, which will significantly again reduce this deficit from 5.5 and show a much more stronger effort at fiscal consolidation than is shown here. So I think that's the end of it, and thank you very much.
Thank you. That was the Governor of the Central Bank, who's also the Chair of the Monetary Policy Committee, Dr. Kamau Thuge. And what we'll do now is go into the questions. We begin with Brian Ngugi from the Standard newspaper, and Brian asks two questions actually. One, what actions did you take regarding the 10 banks accused of currency manipulation? You previously expressed concerns about the differences in their spreads. There is a related question from Brian, who continues to ask, what measures will you implement for the 5 illegal auto financing companies? Asking, will you freeze their accounts? So Brian Ngugi from the Standard newspaper. Then a couple of questions as well from Kevin Rotich. Kevin is from Capital FM Business. Kevin is asking for clarity. So he says, clarify if the parallel market is experiencing a resurgence due to the disparity between the CBK rate and the rate used by EPRA, that's the energy regulator, to determine fuel prices. Second question from Kevin, when can we expect the depreciation of the Kenya shilling to cool down? Is it by the end of this year or next year? So 2 questions each from Brian Ngugi from Standard and Kevin Rotich from Capital FM Business.
Okay, there's a question from Raman Yang on the... Or start with... Okay, let me start with Brian Ngugi's questions, which were what actions did we take regarding the 10 banks accused of currency manipulation? And you previously expressed concern about the difference in their spreads. Let me first of all say we didn't accuse them of currency manipulation. what we did see is some fairly wide spreads in the purchase and sale of foreign exchange, and we sought explanation as to why these spreads were wide. And we just wanted to have an explanation because it appears to go against the foreign exchange code that had been issued to the banks. We did some targeted inspection for those particular banks. The reports were completed. They were then sent to the bank's management as well as the board for a response, and that process is still ongoing. Of course, if we find out that there is some violation of some of the codes, that action will be taken as required by the law. On the measures, what measures to be implemented for the 5 illegal auto financing companies? Will you freeze the accounts? Again, this is a discussion we had with Parliament a few days ago, and what we committed to Parliament is that within the next 14 days we would look into the matter and we'll revert to Parliament. On the Kevin Rotich, says that to clarify, if the parallel market is experiencing a resurgence due to the disparity between the CBK rates and the rate used by EPRA to determine fuel prices. I don't believe that there was initially a parallel market where there was a big difference between what the banks were charging their clients and what was the interbank rate. I think that spread has narrowed quite significantly, and I think now the spread is only about 2 to 3 shillings. So I don't think that the issue of the EPRA and the rate used by EPRA, that is no longer an issue. There's a question as to whether we can expect the depreciation of the Kenyan shilling to cool down. Is it by the end of this year or next year? So I'll say that the measures that we have taken are indeed meant to deal with this issue of the depreciation of the exchange rate and of the shilling exchange rate. Our view is that, and I've said this before, that we thought that the exchange rate was overvalued for quite some time. There has since been significant adjustment, and we now feel that the shilling has depreciated enough, and indeed may have overshot the rate that is required to have an equilibrium rate that is stable, that is competitive, and that will help reverse some of those ratios that I read a few minutes ago regarding what has happened to our exports to GDP ratio and what has happened to our share of exports. So we do think that this strong action that the MPC took yesterday will address the depreciation of the shilling. But I also did indicate that we are going to watch very closely the impact of this action on the exchange rate, on inflation, and if it becomes necessary, if the exchange rate does not stabilize as we expect, then we will take stronger action to ensure that the exchange rate is stabilized. We are very committed to ensuring that we have a stable macroeconomic environment. A shilling that continues to depreciate almost in a straight line does not indicate a situation of macroeconomic stability, and really we can't have sustained economic growth unless we really stabilize the macroeconomic environment. So, as I said, these actions are intended to stabilize the exchange rate We're intended to bring inflation back to our target, the midway target of our inflation target, which is 5%. And the central bank stands ready to take additional action to make sure that we achieve those two objectives.
The second batch of questions begins with Rama Nyang. Rama is from CGTN Africa. The question is a plan to do a $500 million buyback of the 2024 Eurobond still in place? If so, will it be paid entirely out of the foreign exchange reserves this month? Related question from David Herbling from Bloomberg News, who asks, will Kenya's planned Eurobond buyback be at par or nominal rates or at discounted market prices? When do you expect to receive the $1 billion from China, and will this also be used to settle the 2024 Eurobond? Otiato Guguyu from Maudhui House is asking, what are the projections on Forex reserves post-Eurobond settlement, and how will CBK manage perceptions of lacking firepower to manage volatility then?
Let me start with Rama's question. And first, just to say that we are not using our foreign exchange reserves to buy back the Eurobond. What I've indicated in the past, and I think also what the National Treasury has indicated in the past, is that we would use financing, external financing from our development partners to do the buyback. As far as I'm aware, the National Treasury is mobilizing external resources from regional development banks, as well as multilateral development banks. And as far as I'm aware, the buyback is still on. Of course, it will also depend on how much money they are able to mobilize quickly. So, as far as you know, it's still on. On the issue raised by Herbling, whether Kenya's planned Eurobond buyback will be at par, nominal prices, or at discounted market prices. When do you expect to receive the $1 billion loan from China? Will this also be used to settle the 2024? I think on the China loan, I think suffice it to say that the National Treasury is engaged with the Chinese government to get the $1 billion. The timing of that is still not certain, but I believe that that could be coming in this financial year that will end in June 2024. But the timing is yet to be ascertained. Of course, were we to get it before the June 2024, it could be part of could be used to address the maturity of the Eurobond. Now, whether the buyback is going to be done at par or nominal prices, I think that we'll have to leave it to our advisors. They have the National Treasury has recruited some advisors, and they should be able to advise on how to do the buyback. There's a question by Otiato. What are the projections on Forex reserves post-Eurobond settlement, and how will CBK manage perceptions on lacking firepower to manage volatility then? As I've indicated, the Eurobond will be fully financed from the expected external financing from the multilateral institutions, the regional development banks, syndicated loans. So we don't see the settlement of the Eurobond having any impact on our international reserves. So post Eurobond settlement, we will still have enough resources and enough international reserves to be able to deal with a volatile situation or even some of the external shocks.
All right, third batch of questions. We begin with Samuel Kantai from CGTN Africa. He asks, following the noticeable trend in FDI reduction and its impact on the Kenyan currency, would other measures have sufficed rather than the increase in the CBR? Herald Alo from the People Daily. Now that inflation is within the targeted range and the Kenya shilling depreciation is slower, is there any chance that CBK will start cutting the CBR in the first quarter of 2024? Samuel J here from Renaissance Capital is asking, the government has increasingly borrowed from external sources. What does this mean for domestic borrowing targets and the interest rate environment?
So let me start with Mr. Kantai's question on the noticeable trend in foreign direct investment reduction and its impact on the Kenyan currency. Would other measures have sufficed rather than the increase in the CBR? I think, as I said, the reason why we have increased significantly the CBR was to address the risks and the uncertainty that has been introduced in the economy because of the depreciation in the exchange rate. It seems nobody knows where the exchange rate is going to be next week or the week after. That depreciation has also interfered with our mandate of price stability and has been contributing to increase in inflation. So in our view, it was very critical that we address that depreciation to address the cost of living, to address the increase in debt service and the external debt, to bring back macroeconomic stability. And those are actually the things that will encourage foreign direct investments to come into the country. So I believe that the action we've taken will deal with stabilizing the economy. And as I indicated earlier, it's only with a stable macroeconomic environment where you're going to have inflow of foreign direct investments as well as the domestic investments as well. The question from Harold Alu is that now that inflation is within target range and Kenya shilling depreciation is slower, any chance that CBK will start cutting the CBR in Q1 of 2024? What I would say is that the decisions of the Monetary Policy Committee are data-driven. We will continue to monitor the developments on the exchange rate. We will continue to monitor the developments with regards to inflation. In the case that we have really stabilized the exchange rate and inflation is back to our midpoint of 5%, then we would be in a position to consider a lowering of the CBR rate. But until then, we will maintain it there and make sure that we have stabilized the exchange rate and that we have brought down inflationary expectations and inflation towards our midpoint target. There's a question from Mr. J here, and he says the government has increasingly borrowed from external sources. What does this mean for domestic borrowing targets and the interest rate environment? What I would say is that certainly for this fiscal year, the government has barely borrowed any external sources. In fact, most of the external financing is coming in the second half of the year. For example, the IMF money is coming in January. The World Bank money related to the development policy operations is coming around March. And of course, the other disbursements will be coming towards the end of the financial year. Once those external resources come in, we expect domestic borrowing to reduce We expect pressure on interest rates, domestic interest rates to ease, and therefore I think, and of course it's also going to be strengthening our international reserves, and also further reduce the pressure on the exchange rate.
Final question to begin with Gideon Sang from NABO Capital, who's asking for clarity on the justification of expected rebound in economic growth in 2023 and 2024. Churchill Ogutu from IC Asset Managers is asking, has the CBK intervened in the market between June 2023 and November 2023, and what has been the size of the intervention during this period? Herald Allo from the People Daily again, final one, is CBK still following up on the separation of M-Pesa from Safaricom, or is a plan on hold? And he continues, lastly, has CBK issued a license to Flutterwave, or when should it happen?
Mr. Sang asked to clarify our justification for expected rebound of economic growth in 2023 and 2024. I think, as I mentioned, the growth for 2022 was 4.8%, and this was despite the drought that we experienced last year, and where the agricultural value addition contracted by minus 1.6. So actually what drove the growth last year was the services sector, which grew by roughly 7%. So this year we have seen a significant turnaround in agricultural production. In the first quarter we saw agriculture grow by 7.7%. And then in the second quarter, they continued to grow significantly by 6%. So for the first half of the year, we saw a significant turnaround in agricultural production. The services sector also continued to do quite well. There was a bit of a slowdown, maybe from 7% to about 6%, roughly just slightly over 6%. So the turnaround that we are seeing in this year is primarily because of the turnaround in agricultural production value addition, and we do see continued good weather going into 2024, and therefore we will still continue to have robust agricultural growth, plus continued resilience in the services sector, and so that's why we are seeing growth this year to be about 5.5, and for next year to be anywhere between 5.5 and up to 5.9%. There's a question from Mr. Ogutu whether has the CBK intervened in the market between June 2023 and November 2023. And what has been the size of the intervention during the period? Well, I would say that we have, let me put it another way, we have engaged the commercial banks since June about how to resuscitate the interbank foreign exchange market. We engaged the banks, and we asked them, what was needed to reinvigorate the interbank foreign exchange market, and they give us a list. They said there was a circular that was issued in 2011. That one needs to go. So so based on our discussions with the commercial banks, we've actually done a lot of reforms just to deepen the foreign exchange market, and just to prepare that market for appropriate price discovery for the shilling exchange rate. The latest one is the electronic matching system, where now the banks should be able to buy and sell foreign exchange in an electronic platform. That was not there before. And this has been put in place within the last, I would say, between the last 3 to 4 weeks. So we have intervened in that sense. But if the intervention that is meant here is whether we have been selling foreign exchange into the market, we have not sold foreign exchange into the market since June 2023. But having said that, we also think that the actions that we have taken to raise the CBR by 200 basis points, that should also reduce pressure on the exchange rate. I know that there's a lot of people who have been holding dollars in the banks, or even using dollars as an investment asset, expecting the shilling to go up. And as I said, we are determined to make sure that we are going to tighten monetary policy until the exchange rate is stabilized and finds its true level, which in my view has the current rate has overshot that true value. And we do believe that once those holding dollars know that we are serious and determined to stabilize the exchange rate, we should see flow of foreign exchange back into the interbank foreign exchange market. Mr. Allo asked whether CBK is still following up on separation of M-Pesa from Safaricom, or the plan is on hold. And then lastly, has the CBK issued license to Flutterwave, or when should it happen? The separation of M-Pesa and Safaricom is it's still the plan, because the central bank must be able to oversight M-Pesa. There has been some complications, I think, in terms of the amount of tax that Safaricom would have to pay for that separation. I know Safaricom is engaged with the National Treasury to see how that can be dealt with. But yes, the plan is still on. On Flutterwave, we have not issued a license. I know there were some court cases that have been resolved, but we are yet to issue a license to Flutterwave.
So thank you. That brings us neatly to the end of the press briefing, not just for today, but for the year. As the governor indicated, this is the last MPC meeting of the year that was held yesterday within the month of December. And so the next one is expected in February. But as a press release says, if there's any need to meet sooner, the MPC stays ready to take that step. But for now, on the understanding that this is the last one, we wish you Merry Christmas, Happy New Year, Happy Holidays, and see you again when we meet next time in February of 2024.